Today is Monday, October 20th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMI's Senior Ag Analyst, Mark Bowman, ADMI's Senior Market Research Analyst, and JP Steiner, ADMI's Associate Economist. Starting with the grains this morning, Mark. With the U.S. harvest rolling along and China not buying any soybeans, how have prices held up so well?
Yeah, Kurt, I think there's a lot of things at play here. First off, President Trump has sure seemed to have softened his tone when talking tariffs and trade deals with China. We still expect President Trump and Yi to meet later this month in South Korea. The president seems pretty optimistic a trade deal beneficial to both sides can be reached, one where China returns to buying their normal amount of U.S. soybeans while also lifting restrictions on rare earth materials, which is so critical to the U.S. Technology and other manufacturing. China, on the other hand, is looking for reduction or elimination of U.S. tariffs on their exports to us, while also wanting our access to our most advanced AI computing chips. While China has upped their soybean imports from South America to fill the void from the U.S., they have started to slow their purchases here in recent weeks, citing an increase in costs from Brazil as their own crop supplies start to tighten up. Right now, it's estimated China needs between 8 and 10 million metric tons of soybeans for this December-January timeframe ahead of the Brazil's harvest early next year. This amounts to roughly 300 to 350 million bushels. And if that demand shifts to the U.S., it could have a significant impact on the U.S. balance sheet. With the government shutdown, we don't know exactly where we are with U.S. harvest. However, I'd expect bean harvest right now to be approaching the 75% level. Not sure where U.S. production is either. USDA raised their yields for U.S. beans in the month of August and then turned around and lowered them in September. That's something we've only seen twice now in the last 35 years, and both times final yields ended up, in those 2 years, ended up below that September forecast. So I'm leaning towards lower production as it stands right now. The USDA export forecast is too high, but it might not be if we get some of this demand back from China. So I look for lower production. Probably, I think they push to see U.S. ending stocks back above 400 million bushels. And if we did, that'd still be less than half of what it was during the last trade war with China in 08-09 or 18-19. And U.S. farmers, they've been really slow to sell this year's crop, storing everything that they can, waiting to see what sort of financial aid package the Trump administration puts together. And right now that's on hold because of the shutdown. So to me, if we get some of this demand back from China here before the end of the year, I look for spot beans to get up into that $10.75, $11 level. If nothing from China, and we have no issues with South American production, I think you're going to see beans fall back below that $10 level.
Speaking of South American production, Mark, it's this time of year, really not uncommon to start watching the South American growing season. How is the South American weather shaping up?
Right now, real good. Argentina, they've had a good mix of rain and sunshine. They're about a week ahead of their normal pace on getting their corn crop in the ground. Next month is when they really start to shift focus on getting the beans in the ground. In Brazil, similar situation. Soybean crop, they're about 25% planted. First crop corn, they're almost 15%. Again, about 50%, about a week ahead of the normal pace. Right now, we've seen some scattered showers across northern Brazil. Really going to need some more. However, it's been a little bit slow in shifting over to their monsoonal season, but it looks like on schedule here the last half of October.
Thanks, Mark. JP, on the financials front, what should traders be watching for this week?
It's a heavy week of corporate earnings. Nearly a fifth of the S&P 500s due to report results this week. Some major names on the docket include Tesla, Intel, Netflix, and Coca-Cola. I'd be paying close attention to forward guidance this earnings season for any signs of hits to demand and as hits to companies' bottom lines as a result of tariffs. Especially given the absence of government data the last 2 weeks, markets looking to lean on corporate signals to help gauge the health of the economy and also the state of consumer demand. Moving forward to the end of the week, Friday, we will get CPI inflation data for September. That's going to be the only government report at least, that will be released in the wake of the shutdown. The Bureau of Labor Statistics calling back some employees to produce the report for Social Security cost of living adjustments. Regarding the report, inflation is expected to rise 0.4% on the month, landing at an annualized rate of 3.1%. While core inflation is expected to rise 0.3% on the month. Import-sensitive sectors are expected to show impact of higher price impacts due to higher tariffs, although economists and investors like myself could be paying close attention to see if the areas that already have seen price spikes continue to see further price pressures, or if some of these price pressures are just going to be one-off. That will be a very interesting regarding the data. Elsewhere on the data front will be PMI data on U.S. manufacturing and services activity. PMI data is always important in my eyes, as it serves as a leading indicator on business activity. But with the lack of government data, especially on the labor market, the PMI data will serve as a valuable gauge to see how hiring activity among private businesses is holding up. I also like PMI data because it offers clues on consumer sentiment, and it will be interesting to see how sentiment has held up in the wake of the shutdown, and if companies are reporting any drag on a result on their businesses. Recent PMI data has shown that price pressures continue to mount on businesses as a result of tariffs, and that businesses have been taking the hit from tariffs for the most part due to the competitive business landscape and waning consumer demand. Elsewhere on Friday, we will also see the University of Michigan's consumer expectations and inflation expectations report. So for the week, corporate earnings and forward guidance, along with any trade news between the U.S. and China. Scott Bessent is expected to meet with his Chinese counterpart this week. That will keep investors busy until Friday, where we get the CPI report and PMI data offer an insight into how the economy is performing and adjusting to the tariff landscape.
And JP, the CPI inflation report on Friday, does it matter to the Fed?
While the report is important, it really will do little to deter the Fed from cutting interest rates at its meeting next week, in my opinion. Recent comments out of Fed officials, including Fed Chair Powell, have signaled that the Fed is more worried about the risk to the labor market than it is about tariffs' impact on inflation. Now, the Fed will go into the next week's meeting partially blind, the government shutdown preventing the release of several important economic data pieces, putting the Fed in a less than ideal situation. Some policymakers, though, still remain worried about the inflation picture, although, like I mentioned, a lot of policymakers there are shifting their focus towards the state of the labor market. Official employment data hasn't been released since the start of the federal shutdown, which began on October 1st. But with what information that we have seen and information that is available points to still weak job growth. The Fed's own economic field reporting, which is still underway as the Fed is self-funded, showed possible cracks in consumer spending, and recent business confidence surveys have pointed to a dip. The big question for everyone really is what's happening with the labor market, and what we do know and what we have seen. I would expect the Fed to look past any uptick in inflation in regards to cutting rates next week, although a strong reading could lower the chances that the Fed will move to cut rates in December. Right now, markets are pricing in around a 99% chance that the Fed will cut rates next week, and we're seeing a 98% chance of another 25 basis point cut in December, showing that markets at least expect the Fed to move past this week's inflation data, although not disregarded entirely as it moves to support the labor market.
Thank you. Mark Bowman, hard to look at the coffee prices in the grocery aisle. I mean, really. And now here we are back approaching contract highs. Why is this rally so stubborn?
Well, those 50% tariffs on Brazilian imports is especially important to coffee because the U.S. gets about 1/3 of its coffee from that country. And this has brought a drawdown in certified stocks at the ICE exchange, not normally something that the market looks at, but in this situation, it has. Stocks seem to keep falling day after day. They've been down for 23 straight sessions and their lowest since March 2024. So until we get some sort of resolution on that tariff situation, we could still see stocks continue to dwindle, and that provides underlying support. There's some hopes that we could get some progress on lifting those tariffs after Trump exchanged pleasantries with the Brazilian president, Lula da Silva, at the UN last month. And after a subsequent telephone conversation between the two of them, they both described as positive. We did have a meeting this past week on Friday between the Brazilian trade minister and the U.S. Secretary of State Marco Rubio, described as productive. And there's suggestions they will meet, Trump and Lula, but the progress towards that has been very slow. On top of that, we do have some concerns maybe developing with the Brazil's 26-27 crop, which should be starting to go into flowering and follow up with pollination and cherry setting. The rains for the rainy season have been slow to arrive. What rains they've seen in Minas Gerais and the coffee producing areas have been scattered and inconsistent. And so we knew they need that to develop by the end of this month. For me, this is supposed to be the on year for the crop. And so far, if we don't get some widespread range coverage by early November, this could start to draw more attention. We may even be seeing it already.
And Mark, let's shift over to the crude oil market. Why the drift lower in crude oil right now?
So we've had these, OPEC Plus throughout since the spring has been lifting its export quotas, and surprisingly fast. And that is expected to hit the market either late this year or into next. They've actually slowed their increases lately, but still, this is kind of this thing that's moving ahead of us and down. The offsetting factor maybe being, the possibility of a Russian crude, interruptions to Russian crude exports. So far, the sanctions have been ineffective, though, going mostly to India and China. Trump trying to use the tariffs against India to try to convince them to stop buying Russian crude. But again, that will happen in November at the earliest, and possibly not till December if India actually does it. There's been no real actual confirmation that they are going to do that. We also then on Friday, Trump met with Zelensky, didn't come through with the Tomahawk missiles, and that maybe the market's thinking, okay, maybe a more conciliatory tone towards Russia as Trump tries to get a peace agreement between the two of them, but finding it difficult. We've had the peace in the Mideast, which is not a direct impact on crude supply unless it enables Red Sea shipping, but that would require something conciliatory from the Houthis or from Iran. And one of the things that have been supporting market were the Ukrainian drone strikes on Russian infrastructure actually had the opposite effect because it affected their refining capability, which actually meant they consumed less crude, leaving more for exports. And on top of that, we have the U.S.-China trade disputes that have raised concerns about demand. Last week, we had these tit-for-tat fees on shipping. But on the other hand, that Mideast piece is tenuous. We've had some flare-ups over the weekend between Hamas and Israel. And as Mark said, Trump has said on Friday he would meet with Chinese President Xi in a couple of weeks, and that may start to stem some of those demand concerns. And those Ukrainian drone strikes at least have been not reported on. They've been, things that quieted there in the last couple of weeks and kind of pushed that to the background. So we may be reaching a point where at least the market's going to find some support and kind of stem the recent sell-off.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.